Stock buybacks, also known as share repurchase programs, occur when a company uses its cash to buy its own shares on the open market. These programs have become an increasingly popular way for companies to spend excess cash and return value to shareholders. Buybacks increased in the 2000s, reaching a record 4-week average high of $2 billion in March of 2021. Additionally, buybacks reached their second highest monthly total of $200 billion in April of 2021. However, the practice is controversial, with many critics arguing that buybacks can artificially inflate stock prices and crowd out better ways for companies to use their earnings. Let's take a closer look at how companies do buybacks and why, some of the potential benefits and downsides, and how they could impact investors. When a company earns a profit, it has some choices. It can reinvest the money into its business, pay a dividend to shareholders, or buy back stock shares. Reinvesting the money can help the company grow through research and development, or R&D, or by expanding into new markets. However, some companies are limited in their ability to grow their business and seek to return capital to investors. These companies can choose to pay a dividend or buy back shares. So why have buybacks become such a popular choice? First, let's talk about how buybacks work. The buyback usually begins with an announcement that includes a dollar amount the company plans to spend and a time period during which it plans to buy. There are several buyback methods, but the most common is the company buying back shares on the open market. The company will attempt to buy back the shares a little at a time over the buyback period. Investors wishing to cash in will simply sell the shares from the brokerage account. After the buyback, there will be fewer outstanding shares, meaning fewer total number of shares available on the market. This can have a number of benefits for the stock. First, fewer outstanding shares can boost the stock's financial metrics, like earnings per share or EPS. For example, if a company had earnings of $2 million and 1 million outstanding shares, the EPS would be $2. If the company bought back 100,000 shares, the earnings of $2 million would be divided by 900,000 shares for an EPS of $2.22, holding all other variables equal. The remaining shareholders now have a larger claim to the company's earnings. EPS is a fundamental driver of a stock's price. There are several reasons a company might choose buybacks over dividends. Buybacks allow the company to reward investors while attempting to protect the price of the company's stock. Dividends also reward investors, but when they are paid, the stock price often adjusts down. During a buyback, investors can sell shares and get cash with a lower risk of pushing the stock price down. Buybacks can also have tax benefits. While dividends require investors to pay taxes in the year they're received, potential stock appreciation from a buyback can be realized whenever the investor decides to sell and potentially be taxed at a lower rate. Finally, a buyback can often offset the increased number of outstanding shares from the exercise of employee stock options. Despite the benefits, there are numerous criticisms of stock buybacks. First, some stakeholders are concerned that corporate buybacks are simply a way to inflate the stock price. A study from 2011 to 2019 by Ned Davis Research found that the S&P 500 would be 19% lower without stock buybacks. Proponents of buybacks would see these numbers as evidence that the company is accomplishing its primary goal of maximizing shareholder value. Economist William Lasnik, a leading critic of buybacks, argues that the focus on shareholder value creates the wrong incentives. For example, much of the company's management is compensated through stock options and awards. This may provide an incentive to push the stock price higher instead of organically growing the business. Critics also argue that buybacks put companies in a bad financial position. Using cash to buy back stock reduces the company's liquidity because it reduces the cash on hand. For example, in 2017, President Trump and Congress passed a corporate tax cut with the hope that corporations would use the money to expand their businesses and create jobs. However, many companies, like airlines, use the tax savings to fund stock buyback programs. Of the $297 billion in tax savings, $92 billion went to buybacks. When the COVID-19 pandemic hit in 2020, many airlines found themselves low on cash and had to receive a bailout from taxpayers. Of course, airline executives didn't know that COVID-19 was around the corner, and they made a decision based on what they thought was best at the time. An even riskier practice is when companies borrow cash to fund share buybacks. This is called a leverage buyback and could put the company in a precarious financial situation. Fitch Ratings, a corporate credit rating agency, has warned that companies could be slapped with a lower credit rating for leveraged stock buybacks. Finally, buybacks divert money that could benefit the company elsewhere. For example, in some cases, as buybacks have increased, R&D investment has fallen. In 2018, only 43% of companies in the S&P 500 recorded R&D expenses. Just 38 of these companies accounted for 75% of the total R&D spending. Additionally, more investment into employees could result in greater company productivity. Companies could also use the money to expand the business into new markets, create new stores, open new factories, update systems, and so forth. These investments could be better for the company in the long run than the short-term price gains from a buyback. So, what do buybacks mean for investors? A lot of investors have enjoyed the benefits of stock buybacks by seeing stock prices rise. In fact, looking for stocks with buyback programs is a common criterion for many growth investors. Investors should pay attention to buyback announcements and program start and end dates because they could flag changes to the stock growth. However, if borrowing costs rise or if cash positions dwindle, companies may be less likely to buy back stocks, and price growth could slow. Additionally, some politicians have introduced legislation to limit stock buyback programs. If passed, these bills may limit the effect buybacks have on stock prices, so investors may not be able to depend on growth through buybacks forever. Investors should determine if companies can grow on the respective businesses alone and not rely on buyback programs.